First, let's define what whole life and term life insurance are. Term life insurance provides coverage for a specified period, typically 10, 20, or 30 years. If you pass away during that term, your beneficiaries receive a death benefit. If the term expires and you're still alive, the coverage ends with no payout. Whole life insurance, on the other hand, provides lifelong coverage as long as you continue paying the premiums. It also has a unique feature, the cash value. This means that over time, a portion of your premium is invested, growing the value of your policy. This cash value can be borrowed against, or in some cases, even withdrawn. It acts as a living benefit, which is one of the reasons why whole life insurance tends to be more expensive than term life insurance. 2. Premiums and cost differences. Now let's talk about premiums. In general, term life insurance premiums are lower than those for whole life insurance, especially when you're younger. This is because term life insurance doesn't build cash value and only provides coverage for a limited time. With whole life insurance, the premiums are significantly higher, but this is because the policy lasts for your entire life, and you are also paying for the cash value accumulation. The cost of premiums for term life insurance will depend on factors like your age, health, and the length of coverage. For whole life insurance, in addition to these factors, the premium amount will also depend on the coverage amount, the insurer's policies, and the potential growth of your cash value. Keep in mind that your premiums for term life insurance will remain level for the duration of the term, but with whole life insurance, premiums can be higher but stay fixed throughout the life of the policy. 3. Cash value and investment growth. One of the main advantages of whole life insurance is the cash value. As mentioned earlier, a portion of your premium payments goes into building this cash value. This cash value grows over time, often at a fixed interest rate, depending on your insurer's policy. With whole life insurance, you can also borrow against the cash value of the policy or withdraw it entirely. However, keep in mind that loans against your policy's cash value come with interest, and any unpaid loans will be deducted from your death benefit. The cash value growth is often slow in the early years but accelerates as time goes on, providing a long-term benefit if you keep the policy. In contrast, term life insurance does not offer any cash value, meaning that while the premiums are lower, there is no return on the money you've paid into the policy. Once the term ends, you receive no refund or accumulation of value. 4. Total costs over time. To calculate the total cost of both policies, you need to look at how long you plan to maintain the coverage. With term life insurance, if you only need coverage for a set period, say 20 years, you'll pay lower premiums for that term. However, if you outlive the policy, the total amount you've paid in premiums is gone, and you'll need to renew or purchase a new policy if you still need coverage. Often, new premiums are higher due to your age and health, which can add up over time. Whole life insurance, despite the higher premiums, is designed to last your entire life. Over the long term, whole life insurance can end up being more expensive due to the higher premiums, but it does offer lifelong coverage, the ability to build cash value, and more predictable costs. The cash value accumulation provides you with an asset that can be accessed in the future, and it can be used to offset premiums or as a financial tool later in life. 5. Long-term considerations. When calculating the total cost, it's important to consider the long-term benefits and drawbacks. Whole life insurance premiums are fixed and guaranteed not to increase as you age, which provides stability over time. However, if you only need temporary coverage, the cost might outweigh the benefit. For example, if you only need insurance until your children are financially independent, term life might be a more cost-effective choice. On the other hand, if you need lifelong coverage, or you are looking for an investment-like component along with your insurance, whole life insurance might be the better choice, despite its higher cost. The growth of the cash value can be a significant benefit in the long run, especially if you can access it for retirement or other financial needs. 6. Conclusion. Ultimately, the choice between whole life and term life insurance comes down to your needs, financial goals, and how long you expect to need coverage. If you need affordable, short-term protection, term life is a solid option with lower premiums. However, if you want lifelong coverage with the added benefit of cash value accumulation, whole life insurance could be the better choice. Keep in mind that the total cost of a life insurance policy is not just about the premiums, but also the long-term value, cash value growth, and how long you expect to keep the policy. Before making a decision, it's a good idea to consult with a financial advisor or insurance expert who can help you analyze your specific situation and goals. Remember that life insurance is a tool for protecting your loved ones, and choosing the right type will ensure that you are financially secure for years to come. Thank you for watching, and we hope this video has helped you understand the total costs associated with whole life versus term life insurance. Both whole life and term life insurance policies can be customized with riders or additional features to enhance the coverage. These riders may come at an additional cost, so it's important to consider them when calculating your total expenses. For example, a term life insurance policy can have an option to convert it into a whole life policy at the end of the term, which provides the flexibility to switch your coverage type without a medical exam. There are also riders like the accidental death benefit, which pays extra if death occurs due to an accident. In the case of whole life insurance, you may be able to add a waiver of premium rider, which means if you become disabled and can't work, the insurer will continue to cover your premiums. There are also accelerated death benefit riders, allowing you to access part of your death benefit in the event of a terminal illness. These options come with additional costs, but can provide useful benefits depending on your situation. 9. The impact of inflation on whole life insurance. One factor often overlooked is the impact of inflation, especially for long-term policies like whole life insurance. Over time, the cost of living will likely increase, and the amount of coverage that seemed sufficient when you bought the policy may no longer meet your needs. However, many whole life insurance policies include a feature known as a dividend that can help combat inflation. These dividends are a portion of the insurer's profits and may be used to increase your death benefit or accumulate additional cash value. While whole life insurance is designed to provide lifelong protection, it's crucial to